Welcome to Proficient Financial Planners YouTube channel, Financial Education and Awareness Series. Welcome to our journey into the behavioral biases of investors, where we will explore various personal human biases that shape investors' financial decisions. In this video, we will uncover common personal human biases and understand how they can lead investors to make bad financial choices. What is bias? A bias is a way of thinking or acting that is not always fair or logical, often based on habits, emotions, or personal beliefs. It happens when our brain takes shortcuts to make decisions, but these shortcuts can sometimes lead to mistakes. In personal finance, biases can result in decisions by investors that may be bad to their financial health. There are several common behavioral biases that can lead investors to make bad financial decisions. Mental accounting bias. Let's look at the examples and understand this bias. People treat money differently depending on where it came from and what they think it should be used for. Separating the money into mental accounts for different uses influences our spending, investing decisions. Example, in the first video, person is conservative towards salary, hence spending and investing decisions taking on plan basis, while in the second video, person is liberal towards bonuses or windfall gains and spends without thinking or planning. Another example is delaying prepayment of high-interest loans while keeping money parked in low-interest earning debt investments. Loss aversion bias. This bias can prevent people from making rational decisions by focusing more on avoiding losses than on potential gains. Let's look at the examples and understand this bias. Bias towards investments. In the first video, investor is holding firmly on gold investments for long period, though it's not giving high returns over a long period of time. In the second video, investors is not willing to shift money from FD to equity for their retirement goal. Another example is, in the stock ABC, invested amount is 1,000 rupees. Sold amount is 2,000 rupees. So net profit is 1,000 rupees. In the stock XYZ, invested amount is 3,000 rupees. Present market value is 2,000 rupees. Hence notional loss is 1,000 rupees. The pain from the notional loss of 1,000 rupees will be much more compared to the gain on the investment with loss aversion bias. The biggest financial mistake people make is taking too little risk, not too much risk. People save rather than invest, even though inflation will erode the value of their savings. Loss aversion causes us to avoid small risks even when they're probably worth it. Anchoring bias. This bias can make people overly reliant on initial numbers or reference points, even when they no longer apply. Let's look at the examples and understand this bias. We tend to cling to the first piece of information that we get, and relatively make subsequent judgments. Anchoring influences the decision-making process and lead us to making irrational decisions. Another example is, investor is expecting to sell a house for 1 crore rupees because that was its price last year, even though market conditions have changed, and it's now worth 90 lakh rupees. Herd mentality. This bias pushes people to follow the crowd, often leading to irrational decisions influenced by fear, greed, or social pressure. Let's look at the examples and understand this bias. Investing heavily in cryptocurrencies like Bitcoin during its 2021 surge because everyone else was doing it, even without understanding the risks. Another example is rushing to withdraw money from cooperative banks in India, like during the PMC bank crisis, 2019, after hearing about others doing the same, even if their accounts weren't immediately at risk. Investors blindly following financial influencers' advice and tips from friends and relatives, rather than making their own research-based decisions. Here are some real-world scenarios that illustrate herd mentality. Recency bias. This bias makes people overestimate the importance of recent events, leading to decisions that ignore long-term trends or historical data. Let's look at the examples and understand this bias. Investing all money in equity mutual funds and shares after a few months of very good returns during stock market boom, assuming market will never fall, and in the event of market correction selling everything assuming market will fall further. Confirmation bias. This bias leads people to favor information that supports their existing beliefs, often preventing them from making balanced and informed financial decisions. Let's look at the examples and understand this bias. Investors supporting a news or financial guru's prediction about a market growth or crash that they are believing, while ignoring the views or news that don't support their belief. Misinformation effect. This bias can lead to flawed financial decisions by relying on inaccurate or incomplete information. Let's look at the examples and understand this bias. Buying a 20 years traditional life insurance policy with low insurance cover because it's suggested by friend or insurance agent, ignoring its objective of providing financial security for dependents. The policy is not achieving insurance objective nor giving good returns over a long period of time. Another example is, people are using instant loan facility or make the payment via credit cards and ignoring the very high interest rate that credit companies are charging. Due to this, most of the people are not paying the EMIs on time that lead to debt traps. Now we will look at how to overcome the human biases and make more rational financial decisions tailored to your needs and financial goals. Get organized financially. Keep track of all your income and expenses. Knowing what comes in and what goes out can help you avoid several of these traps. Keep all the financial documents in organized manner. Secure your financial documents. Keep emotions out of money. Use tools like budgeting app or create the budget. Use financial calculators to analyze decisions logically. Writing down your goals for the year. Create an investment strategy and stick to it. The objective here is to translate your mental accounting notes into something physical and tangible. Following a financial goal-based investment approach. Define the short, medium, and long-term financial goals. Once the goals are defined, then link to an investment on the basis of your risk profile, goal period, and priority. Avoid reacting to short-term events by keeping your financial goals in mind. Other strategies are, take time for research before taking any financial decision and base your decisions on facts and numbers rather than opinions or emotion. Educate yourself about biases and financial principles to spot when you might be making irrational decisions. Challenge your assumptions and ask, am I ignoring evidence because it doesn't align with my view? For example, if you believe fixed deposits are the safest, compare their returns and risks to alternatives. Set up automated investments, such as SIPs, systematic investment plans, to avoid emotional interference. Consult trusted financial advisors or read diverse sources before making decisions. For example, if you're influenced by a financial influencer, cross-check their advice with reliable resources or experts like SEBI-registered investment advisor. Avoid acting in haste, especially during financial trends or crisis. For example, give yourself minimum 24 hours to think before making a major financial decision. These strategies, when applied consistently, can help you overcome biases and make more rational financial decisions tailored to your needs and financial goals. Thank you for watching this video. Please like, comment, and share this video, and don't forget to subscribe our channel.